So whilst it looks okay, it needs that next leg to confirm the idea of going down. This was its opportunity. If it was going to go lower, it needed to get value down below 23. We needed to see that, and we didn't. The S&P has not continued lower and is in fact actually reversed back. This is why candlesticks alone are not enough. Alright guys, today what we're going to go and look at is why candlesticks on their own don't do enough, and why market profile tells you the real story of what's happened. To use this, or to explain this, I'm going to use an example from just a few days ago. Now, this is one in the S&P. Now, if you like your candlesticks, this is perfect. Yeah, your basic level candlestick type of patterns. What you've got is a shooting star or a gravestone, doji, whichever you want to call it, sitting at the record high. This is your perfect reversal candlestick. It suggests now is the time to sell. And so the strategy here, real simple, sell the open of the following day and look for the most recent lows, that most recent low being the 62.41 level. That's it. But you need more depth of understanding, because as we see over the following days, we do not fall. Instead, the S&P rallies. So why is this? This is where you need that extra layer of depth. If you want to understand more about extra layers of depth and other things that we look at, click the link below, come to one of our workshops, and you will see how we use price ladders and footprint and profiles. But for today, we're going to try and explain why this did not go down when we had such a brilliant looking signal. And ultimately, it's all about the candlesticks don't tell you enough. All candlesticks give you is 4 points, an open, a high, a low, and a close, and that is it. What we need to understand here then is how it was formed. That's what really matters, because the way a candlestick is formed is more important than the end visual look of it. So if we go and break this down then onto a 15-minute chart on the left and then a profile next to it, now we start to see a real story of what's happened. If you follow, this is the regular trading hours session. So these candles are just the RTH session, which is just when the New York Stock Exchange is open, for those who are not sure what the RTH session is. That is then the highlighted profile that we have here. Now, what the chart on the left shows you is the sequence of what's happened. We have a market that rallies strong from the beginning of the day and then starts to consolidate at higher prices between 63.63 and 63.74. Now, what's going on here is the market is building acceptance. So this is how we're getting the top of that wick on the shooting star candle. We're building acceptance up here. This suggests people are quite happy trading at these prices, and seeing as this is on the back of a move up, this is a bullish sign. It's a shift of value higher. Now, when we've got that, this doesn't tell you the same story as the candlestick might. What this is suggesting is people are happy up here, and then the sequence is what matters. The way that we got back down towards the lows to form that daily candle is by a late drop. The late drop is essentially a liquidation of buyers. People who were buying it between 63 and 74, some of them get pushed out. The market starts to drop a little bit and some of them start to sell to exit positions. As that happens, this creates the quick drop. But this isn't really sort of strong selling. Value doesn't move lower. That's a real crucial aspect of it. If you look at value, which is shown by the purple highlight on the volume, this stays high. Most of the volume is still done up in the top part of the day. So what this really is saying is that people who started buying it that day didn't manage to hold on to it and the market dropped back. It would be a very different story if this was a market that traded up quickly early on and then straight back and traded lower. That would be a very different picture, because it would show that most of the trade was at lower prices with an attempt higher that failed. Whereas this doesn't. This shows an attempt higher that does create value and then fails late on. It's a different picture. But still, if we go and look at the daily candle, the play is still there. The straightforward play is sell the open of the next RTH session. And what you're then looking for is a pretty hefty move lower. You're looking to take out the entire range on that chart down to the lows that you can see highlighted at 62.40. Now, what you do need whenever you're playing any kind of bigger swing trade is an understanding of at what point does this become right? At what point is this idea confirmed? Because if you sell it and it's going to open, as you can see here, this is just showing the extended trading hour session at this point in time. So it's going to open still near the close of the previous regular trading hour session. So around about the sort of 63.45 area. You can sell that, but until you get below 23 out of the red box, this is not confirmed as going down. This is merely a market that is in a decision zone. You come out the box to the upside, and we could then get dragged back to where value was the previous day. So if we then go and look at what happens the next day. So remember, this is following the sequence on now. So this is now the day that comes after the red box. And what you get is the beginning of a sell-off. This all looks pretty good. This is a move that then takes you down through 23. So we get below 23 and we start to consolidate at lower prices. This is what you're seeing on the profile here. This was the shooting star candle profile. This is now the next day. This looks good. We are starting to move value lower. That's a positive sign. What we've not done at this point though is get below 23 and stay down there. We're not building value below 23. Look at where all the value is. It's 24 up towards 37. So whilst it looks okay, it needs that next leg to confirm the idea of going down. This again is where sequence matters. As long as it's below 38.5, that's fine. But it's got to put the next leg in, 38.5 being the high of these pullbacks. So until it puts that next leg in, this is still not really confirming the move down. So we know what needs to happen. If, however, you start to go above 38.5, this then changes the picture. And so the rest of this day follows like this. So by the end of the 22nd of July, the S&P has not continued lower and is in fact actually reversed back up the range. So we're now in a situation where, yes, value has shifted a little bit lower, but we've not got that continuation. So what you've now got to think about is, what does this all imply? What was the earlier story and how much has that changed? Now, the earlier story from this day is that, yes, we did have some buyers. There was an acceptance of value at higher prices. Market looks good to go higher. Some of these buyers give up and liquidate down. So they're not really strong sellers. These are just buyers exiting positions, not new sellers. The next day, we get some new sellers attempting to get this to go down, to get it through 23, through the low of the range. It doesn't happen. And instead, the market then closes back higher and also drags value up. It's not a full move higher of value, but it has actually pushed it up. So now what we've seen is basically a market that had the chance. This was its opportunity. If it was going to go lower, it needed to get value down below 23. We needed to see that and we didn't. So all of those people who are thinking this is the top have now got to start to reconsider. You've now got to be somewhat nervous that this is no longer the top. And in fact, actually, we could be running lower. That's what you're really watching out for now. So the next day, there's your shooting star candle day, the failure to shift value lower. The bias now flips again. If you get above 54, which we do, we're opening back above 54, back where value is accepted on the 21st. So now, unless you get back below 54, this is a market that's effectively stepping up. Anyone selling it the day before is now trapped. And in them being trapped, this is what produces that next leg higher, this strong continuation move. So much of this is about understanding the sequence of what happens. You can't just look at a candlestick alone. You need that extra layer of depth, that extra story that's created by the profile. The understanding that it's not the most convincing bearish candle, that shooting star. But for it to become convincing, you need another leg. You need value to shift lower. The market needs to get beyond a certain point, and in its inability to get below 23, I should say, in its inability to do that, it's told you a big story. It's told you that this is not actually a market that wants to go down. And on the break of 38.5, and then the sustain of buying at 54 again, tells you everything you need to know. This is a market that is still going up, and that sell-off was just a brief opportunity for people to come and buy the dip.